Welcome to this explainer. Today, we're acting as a specialized analytical engine to really deconstruct the hidden mechanisms of federal ethical standards for financial and tax professionals. We're diving into a fascinating anonymous expert report that strips away all that generic advice to reveal the hard, underlying logic of professional compliance. We have to treat professional ethics not just as a static list of rules, but as a complex, interconnected ecosystem. Because honestly, if you don't understand the systemic cause and effect relationships governing these standards, you're operating with some massive, unseen liabilities. So, let's analyze the hidden architecture of professional ethics. Here's our roadmap for today. We'll be looking at the dual obligation paradox, deconstructing due diligence, navigating conflicts of interest, managing fees and records, the disciplinary mechanism, and finally, safeguarding systemic integrity. Let's get right into it. All right, Section 1, the dual obligation paradox. We are starting with the fundamental paradox practitioners navigate every single day. Look, on one side, you've got the financial incentive and the professional duty to please, protect, and fiercely advocate for your client, right? But on the other side, that goal constantly grinds against the strict legal mandate to protect the transparency and integrity of the overarching financial system. You're basically acting as a systemic gatekeeper, but you're paid by the very entity you're gating. This misaligned incentive structure creates immense subconscious pressure, where the drive to retain a client can slowly erode a practitioner's objectivity, literally transforming them into a systemic risk. To see how this tension practically plays out, just imagine you're reviewing a file and you notice a glaring, costly omission from a document submitted, say, 3 years ago. Your immediate internal monologue probably says, "Hey, I can just fix this. I know how to file the correction and protect my client from future audits." The implicit assumption here is that fixing a known error is inherently good and helpful, but actually, acting on that well-intentioned assumption without following the precise regulatory mechanics, that is legally disastrous. The legal friction here is absolutely immense. You are absolutely mandated by the regulatory framework to immediately advise the client of the error and clearly explain the legal consequences of leaving it uncorrected. However, taking action to amend it without their explicit consent constitutes a severe breach of agency. The regulatory body intentionally forces the client to be the ultimate decision maker. Why? Well, because this legally insulates the broader system from rogue, albeit well-meaning practitioners who might try to unilaterally alter financial histories. You advise the client, sure, but the liability for the final action stays with them, not the gatekeeper. Okay, moving on to Section 2, deconstructing due diligence. Willful blindness is not just a passive mistake. It's treated by regulatory bodies as a deliberate, active choice to look away. If a client claims a specific benefit, but the underlying facts logically conflict, you are legally required to probe deeper. If you fail to investigate inconsistent information, the legal liability instantly shifts from the client directly onto your shoulders. By choosing not to ask the next logical question, you literally become the legal owner of the client's falsehood. You absolutely cannot bury your head in the sand here. Operating as a truth tester requires a really precise methodology. You are conducting a formal forensic audit, but you must actively cross-reference verbal statements against established legal frameworks. For instance, if a client claims a specific statutory deduction, but their documentation lacks the legally required chronological proof, you can't simply accept the verbal assurance. You gotta ask targeted probing questions that eliminate plausible deniability, actively matching the raw facts they give you against the strict letter of the law. Now, the safe harbor mechanism defines the exact mathematical limit of professional trust. It acts as a baseline safety net, allowing you to generally rely on data supplied in good faith without independently verifying every single receipt. But here's the catch. That net vanishes the microsecond client information contradicts common sense or your established professional knowledge. The system grants you the privilege to trust, but enforces an absolute mandate to verify the moment a red flag appears on your desk. Let's shift gears to Section 3, navigating conflicts of interest. We really need to dissect the implicit conflict here, because it operates as a subtle but devastating psychological trap. Imagine you, as a practitioner, made a minor calculation error on a past filing, and now a substantial penalty has been assessed against your client. The fear of a looming malpractice lawsuit might implicitly incentivize you to advise that client to aggressively fight a perfectly valid penalty. In this scenario, your objectivity is completely destroyed. You are secretly acting to shield yourself from liability, not advocating for the client's best financial outcome. You're fundamentally misdirecting the client's resources to cover your own tracks, which corrupts the regulatory system from the inside out. Now, if a conflict of interest is actually deemed navigatable, the framework imposes systemic urgency. You have exactly a 30-day window to secure explicit, written waivers from all affected clients confirming they understand the conflict. So why 30 days? This rigid timeline prevents prolonged periods of compromised representation. It ensures that any potential systemic damage caused by divided loyalties is aggressively contained and documented. And these waivers establish auditable accountability. They have to be meticulously retained for 3 full years post-engagement. This specific time frame aligns perfectly with standard look-back periods for regulatory audits. It proves that the system demands verified historical proof of compliance, ensuring that practitioner independence isn't just a verbal promise, but a permanent part of the regulatory record. Up next is Section 4, Managing Fees and Records. Banning contingency fees for original filings prevents the creation of manufactured compliance issues. Think about it. If a practitioner only gets paid by securing a specific financial outcome for their client, it fundamentally weaponizes them. They transform from objective representatives into aggressive prospectors, deeply incentivized to take legally baseless positions just to inflate their own payout. This misalignment of incentives totally threatens the fundamental architecture of the system, which is exactly why it's so heavily restricted. The distinction between a private business dispute and federal compliance is absolute. Regulatory bodies prioritize the uninterrupted flow of compliance information far above a practitioner's right to collect a private debt. Even if thousands of dollars are owed in unpaid fees, you can never hold compliance-critical documents hostage. Using federal reporting obligations as leverage in a private billing dispute is a direct violation of professional stewardship. No exceptions. Which brings us to Section 5, the Disciplinary Mechanism. The oversight body enforces its standards through a highly deliberate, escalating hierarchy of consequences. It often begins with private warning letters, basically an attempt to rehabilitate minor, correctable filing errors. But if the behavior establishes a pattern, the system bypasses rehabilitation entirely. It scales rapidly from private reprimands to public censure and ultimately to the permanent suspension of all practice rights. The regulatory machine attempts to course correct first for sure, but it will ruthlessly amputate a repeated threat. The threshold for the harshest penalties rests on a really crucial distinction. The system will tolerate honest incompetence to a degree, but it aggressively punishes deception. Incompetence can be corrected through education and private reprimands. Deception, on the other hand, actively subverts the regulatory machinery. If you intentionally falsify data or coach a client on evading their legal liabilities, the system deploys its maximum authority to permanently eliminate you from the profession. And these expedited procedures, they are a masterclass in jurisdictional piggybacking. To conserve vital resources, if professional misconduct has already been definitively proven before a state board or a court of law, federal oversight bodies don't waste time relitigating the facts. They just absorb that prior ruling, creating a unified, inescapable net of accountability that fast-tracks the immediate revocation of federal practice rights. It's incredibly efficient. Finally, we arrive at Section 6, Safeguarding Systemic Integrity. The entire macro-level integrity of the financial system is anchored right here, to this specific mathematical threshold, the reasonable basis standard.
You are legally barred from advising a client to take a regulatory position that lacks at least a 25% possibility of being sustained if challenged in a legal or administrative forum. So why this precise numerical baseline? Well, it operates as a vital filtration mechanism for the entire economy. It permanently outlaws wishful thinking and forces practitioners to rely strictly on objective legal precedent, case law, and established statutes. By instituting this 25% floor, the system entirely neutralizes frivolous, time-wasting filings before they ever enter the processing queues. You aren't just advising a client, you are acting as the first line of defense, mathematically gating what is allowed to enter the regulatory machinery. We also have to recognize that ethical responsibility transcends individual morality. It is a required corporate infrastructure. For firm leaders and managers, plausible deniability just does not exist. If a subordinate breaches a standard because your internal training protocols were weak or non-existent, the regulatory body views you as the critical failure point. You are directly, legally culpable for the systemic vulnerabilities created by your staff. Ethics has to engineer from the top down.
So, we'll leave you with this. Are your daily professional practices actively fortifying the integrity of the financial system, or merely testing its boundaries? This expert analysis proves that regulatory standards are not just administrative red tape, they are literally the structural load bearers of the entire economy. Consider the deep implications of your internal protocols. Are they built to withstand the rigorous mechanics of federal oversight, or are you dangerously testing the limits of an unforgiving system? Take a hard look at your operations. Thank you so much for joining us for this explainer.